Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jon Ferro, along with Lisa Abramowicz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
We begin with our top story. NVIDIA is looking to bounce back from a $430 billion slump. Mike Wilson of Morgan Stanley expecting narrow market performance to continue, writing this: we continue to recommend a barbell of large cap quality growth with defensives while fading lower quality cyclicals and avoiding the temptation to play for a true broadening out. Today is a good example of that, Mike, given the fact that we are not seeing the Russell 2000 participate in today's enthusiasm. Mike, wonderful to speak with you. Really appreciate it. You've been talking about this for a while, that it's not necessarily this all boats are going to be lifted by this AI enthusiasm. What's your takeaway from the volatility in NVIDIA shares? And to Danny's point, the idea that we have not seen it broaden out to some sort of contagion or real market weakness.
Yeah, well, I think the market is pretty smart, as usual. It's figured out exactly what's going on. We go back to, I think, probably our main narrative, which is probably not consensus yet, which is that this policy mix that we've had is very unusual, right? We had this incredibly strong fiscal policy, which is keeping pressure on the Fed to keep rates higher. We know rates are too high because the yield curve has been inverted. So that is sort of hollowing out or crowding out a good part of the economy and stocks. And so what does the market do? It gravitates to these lifeboats that can actually perform in this very challenging economic environment for most operators. When I say most operators, I'm talking about consumers and corporate. And that's reflected in the data, right? And it's not just the Mag 7, by the way, that's high quality growth. There are some really good high quality growth stocks outside of tech and comm services that have been performing well. And I think you said earlier, this sort of almost like pistons moving around. The VIX is really low and volatility in the S&P 500 is low, but the volatility under the surface is enormous. And so, because it's sort of like the boat that's tilting back and forth. If people are running to different sides of the boat can actually remain fairly stable. And that's what we have going on until there's probably going to be some sort of shock. Maybe it's the elections. And by the way, the elections don't have to be necessarily worried about bad outcome. It's just higher volatility for the broader averages. Like, elections have consequences. And we're seeing that all around the world now. Why is our election going to be any different? When I say consequences, I mean consequences for obviously the economy and for policy, but also consequences for volatility in the marketplace.
So before we get to the elections, and we'll talk more extensively about that in a bit, I do want to talk about the idea of a shock. And you laid out 3 different potential shocks in your recent research, talking about the potential for upside acceleration in inflation. You say nobody's really counting on that, neither do you. Then you talk about some sort of liquidity shock. You talk about the Treasury auctions and some sort of issue with market functioning. And then you talk about what you see as the most likely, which you just flicked at, which is this idea of growth. Right. And that potentially you could see a real fall off in growth, which was kind of what we heard from Mary Daly. What are the signs that we're getting closer to that? And when do you sort of throw in the towel, and that being a near-term kind of reality, if we don't see more material weakening?
Well, the market is already leaning in that direction, right? It's saying that growth is probably going to disappoint. By the way, growth has disappointed this year. Most of the economic surprises have come on the downside. That continues to be the case, which is why that upside case is probably less likely. So how has the market dealt with that? Well, it's gone to large cap, quality growth and some defensiveness, which is very typical in a late cycle economy. The reason we bring this up is because the market's priced for a soft landing, and that is sort of the base case consensus view. That's all well and good. The problem with that is that, let's say it happens, well, where's your there's a lot of upside, which means you got to pick stocks. And so that's what the market's doing. It's doing the best it can in that sort of a setup. So what's the key trigger going to be for us to say, okay, that growth is turning into a real growth scare or potentially recession fear? It's the labor market, right? The labor market, if the labor market breaks down, by the way, that's what the Fed's looking at too. So if we were to see a non-farm payroll number under 100,000, unemployment go to 4.3, 4.4, you better believe the Fed's going to probably cut rates. The market's probably not going to love that initially, unless they cut 100. But 25 basis points into a real growth slowdown, the market will correct probably 10% on that sort of an announcement.
I was going to say, usually the argument of, stocks can survive is because if they cut, then they get some support. But to your point, it needs to be some cut sort of in size. So if we kind of take a step back and say, all right, NVIDIA, clearly there's a lot of valuation here that shouldn't be baked in, that has been multiple expansion. If you just strip that out, Does the rest of the market make sense to you, where we are with everything else?
Well, I mean, like I said earlier, the market makes perfect sense. It's paying up for quality, and it's paying up for growth that is, idiosyncratic from the economy, and maybe some defensive properties. Okay, great. So I think the market totally makes sense. The question is, are those multiples now in those particular stocks too high? I think if you get a perfect, soft landing on this plane, it could be fine. If you get any aberration from that, it's going to be a problem. And that's why we wrote about it this week, which is there's these three risks. Could inflation pick up again? Could there be a term premium spike because of the fiscal unsustainability? Or could there be a growth slowdown? Of the three doors, to put it in Monty Hall terms, I'd take door 3 as the highest risk today. Okay, that could change. And this is another lesson from the last year and a half. I mean, how many times have we changed the narrative in the last 18 months? We've gone from hard landing, soft landing, no landing. I mean, it's like, musical chairs. So right now it's soft landing. Great. As long as that remains stable, we can kind of stay in this sort of environment that we're in. But we have to be, as macro investors and traders, we have to understand these are the risks.
But there's an irony in it, which you already pointed out, is that underneath the surface, you are getting these big moves in stocks. You talked about going from one side of the boat to the other. The other way it's expressed that stocks is just correlation has broken down between individual stocks. And it's not even just an AI thing, because within sectors, stocks are no longer correlated. Is that a troubling turn? Is it a problem that that's happening? Do we need to completely rethink how we judge sectors and how stocks should be moving together?
Well, it definitely affects the latter part of your comment, meaning the idea that you're going to trade sectors is out. Okay, that's not working. So that relative value trade, which is what we kind of made our career, trading relative value in sectors, is not working really well. What's working is factor trading, which is why we're going back to things like quality, defensiveness, large cap over small. That's working really well. Operational efficiency. These are the factors that are working, which is more idiosyncratic. By the way, the breadth in the market today on a 1-month rolling basis is the lowest we've seen since 1965. Okay, that's even older than me. I mean, that's bad, and that's old. So, I mean, that's a long time. It doesn't mean it's necessarily the end of the world. We have many examples where breadth got really narrow and then it broadened out again. But typically, it requires some sort of a regime shift, right? In other words, if we stay in the soft landing narrative, nothing's going to change. If we move to a higher growth, higher inflation, it's definitely going to shift probably more towards cyclicals. If we go into a growth scare or even recession fear again, that's going to be a rotation into defensiveness. So, we're open for anything because that's our job. We have to be prepared for that.
If we do see a reacceleration of inflation, where would it be coming from?
Well, I think commodities could pick up. I mean, there is this talk of maybe China's going to re-stimulate again, so maybe commodities could seep back into it. I don't think it's going to come from housing. I don't think it's going to come from, this owner equivalent rent. I think that's probably on the downside. Maybe it's in services, services inflation. We saw that in the insurance market, things like that. But we're not looking at a groundswell of inflation like we saw in 2020-21, because I don't anticipate this same, impetus from, say, fiscal stimulus really driving the bus in the way that it did in 2021. We need an exogenous shock to get growth to drive kind of a broader inflation. That's why that's sort of number 3 on our list of things that will upset the apple cart right now.
I'm thinking about liquidity right now as your second risk, this idea of treasuries and some of the auctions and what could happen if you get higher yields. But on a broader level, this idea of the lifeboats and the lack of diversity, the sort of lack of breadth in the market, as you said, going back to 1965. At what point does that make the market more fragile? Not less, given the fact that if you have a true downturn, at some point you have to imagine these lifeboats are going to feel it too. It isn't just going to affect everything else that, frankly, in some places have been actually signaling some warning signs about what's ahead.
Sure, and look, all year we've seen one by one some of these lifeboats, sink. I mean, and then, or they at least take on water. So that's normal too, is that, eventually everybody goes to that one boat and then it gets too crowded and it sinks and they jump to the next one. So everything that's going on makes perfect sense in the context of a late cycle economy. That's why we haven't changed our view on that. Like, we don't think it's mid-cycle or this is the beginning of some new expansion. This is classic late cycle behavior, just like 2019 or 2016, 17. I mean, this is exactly what tends to happen. I expect more of the same. And look, once again, I think it's really critical to make this statement again, which is that it's not just tech stocks. Okay, there are plenty of it's like almost like the Nifty 50, right? There's like Nifty 50 stocks that are really people are gravitating to, and they're even more expensive than some of these tech names.
Well, but I guess what I'm trying to get at is, are you going into those names too, or are you steering clear of them because of concentration risk and the idea that one of them could sink, and that could become really problematic?
Well, right now, I mean, we're with everybody else because I think that's what it's a momentum market. Now, I think where we're different than other people is we're saying this isn't stable. To your question earlier, it is fragile. You just have to understand that. And look, these are liquid stocks, so you could, if you're running a portfolio, you don't want to be, doubly overweight some of this stuff, but you need to be leaning in that direction, understanding that you're going to have to move it around in the short term. And if there's a shock, and I think once again that third door is the biggest shock to these Nifty 50 names, meaning a growth scare. A growth scare / recession concern is the one that will take them all down together. That's not a risk today. But that's the one that we're kind of looking at as potential risk in the third and fourth quarter to come back into the marketplace.
Mike, as you're talking about these different lifeboats and some taking on water and maybe less of them out there, I'm kind of reminded of this conversation I had with Pete Stavros from KKR, just the fact that public markets have been shrinking. Since 95, I think, which was the peak in how many public companies we have, there 40% less. Is there some degree where there's just less lifeboats because there are less companies, that some of the really good companies out there, the OpenAIs of the world, what have you, just aren't public anymore?
Well, I think what's happened is, because of maybe the AI narrative in particular, we've seen people perceive certain boats as lifeboats when in fact they got holes in them. Okay, so that's a mistake. I think there's been a rising tide in many cases that has taken a lot of stocks up, probably incorrectly. So those are the names that we're talking to clients about right now. We're saying, okay, there's sort of the AI winners, and then there's the AI pretenders. Okay, there are many, many companies that are talking about AI. They mention AI, the stock goes up like 2 multiple turns. Like, okay, I mean, those are the things I think you need to be more worried about than buying the true AI winners and saying, well, this actually has a business plan or a potential beneficiary, whether it's an enabler or an adopter. And by the way, just to make it clear, we're more interested in the adopters now than we are the enabler trend that's sort of played out. That's gotten priced. So you got to be a little careful. Now it's about who's going to take advantage of this technology to make a better mousetrap, a better business model to win competitive battles with their competition.
Do you want to tell us any of those names?
Sure. We've written reports about this. So I mean, clients can draw them down, but we have baskets and everything else. We publish this every week.
Mike Wilson of Morgan Stanley still with us. We aren't going to ask you about your impression about the debate. Actually, we may do that. But instead of doing that, to begin with, how do you even understand what to listen for in terms of the most market impactful policies from something like the debate that we're expecting on Thursday?
Yeah, I mean, look, this is going to be a challenge for the moderators to draw some answers out. By the way, it's not just because of this debate. This is the way the debates have gone for the last decade. I mean, it's just turns into not really a debate about issues. It turns into personal attacks and whatnot. So let's see if we can focus on a couple things. What I would love to hear about is what is your plan for fiscal sustainability? Okay, is it going to be any different? Is it business as usual? Right now, it looks like both parties are on this freight train of we're not really concerned about, cutting expenses or even raising taxes. I think the Democrats have talked a little bit about raising taxes, but that's going to be the main one for me. Like, what are we doing about this fiscal sustainability issue? Number 2 is going to be tariffs, how they differ on that, and of course, immigration. And some people might say, well, those are social issues. Well, they're not really. I mean, immigration is really an economic issue. I mean, it's a massive positive labor shock. So I think that's going to be a really hot topic from an economic standpoint. And of course, tariffs. I don't see as big a difference between the two candidates as some people do because of the actions more recently by the Biden administration. But I think there'll be some nuances. But those are the 3 big ones for me, economically speaking.
But there is a difference in the sense that Trump is calling for a 10% tariff wall around the United States plus 60% on Chinese imports. When you say you don't think there's a big difference, do you mean that you think this is just rhetoric and he might temper those numbers if he were to become president?
Well, I think he already has. I mean, that's his strategy, right? He's a negotiator where he'll set his BATNA over here and then, kind of move to the middle. That doesn't mean he's going to be softer on tariffs than the current administration. But, he tends to be extreme and then kind of move it over this way. But look, there's no doubt that I think that the Trump administration would probably be more hawkish on tariffs overall than the Biden administration. All I'm saying is that I think this is turned into more of a bipartisan support issue for tariffing in general. particularly against China. So I just don't think it's as big of a deal as it was.
Axios this morning has 16 Nobel economists writing that Trump would be basically very inflationary. We believe that a second Trump term would have a negative impact on the U.S. economic standing in the world and a destabilizing effect on the U.S.'s domestic economy. Do you think Trump is more inflationary for the U.S. economy?
Well, Trump wasn't. I mean, that was our call in 2016, was that, Trump wins, it was going to be really positive for the economy because he is inflationary. At the time, though, we had capacity for that. So I think that in the bond market, participants who we speak with are kind of thinking about this already. In the event that it becomes clear, and we don't know yet, but in the event it became more clear that Trump was going to win, then the bond market may start to price in a bigger term premium, which is one of our potential concerns. I don't think it's a risk right now because it's truly a 50-50, and you do need some congressional support. So it's not clear to me that there's going to be big coattails on this election, meaning whoever wins the presidential carries Congress. But if that were the case, then the risks of that go up. You would get maybe even more aggressive tax cuts in some way, and maybe tariffs can offset some of that. But generally speaking, yes, it potentially could be more inflationary. So better growth, but potentially higher rates.
Okay, so there's potentially an impact on the bond market, but will equity markets care?
Well, they will if it's term premium. And that's been our call now for the past year, which is if rates are going up because of growth and inflation being higher, stock market really doesn't care, at least at the index level. Now, if rates are going up because term premium is widening, that's a bad thing for multiples, generally speaking. We saw that in the third quarter of last year. So, an issue in a situation where the bond market starts to worry about fiscal sustainability in a more acute manner and term premiums started to widen, that would not be great for multiples.
Is this the reason why you don't believe the Fed put saving everything? I mean, this has been one of the arguments of the stock bulls, is that the Fed could cut by 100 basis points, and that could offset any of the weakness and create a real momentum to the market. Is the idea of term premium and the fiscal overhang the reason why you don't know whether the Fed put could actually have the same effect?
Well, what I would say is that the term premium, I think, has been under control more recently for reasons that have nothing to do with rates. It has everything to do with the liquidity provisions they've put into place, smartly, by the way. So the reverse repo has been a big helping hand to help fund the government. Now the Fed, of course, is tapering QT, which is essentially $500 billion of potential bond buying across the curve on an annualized basis. So I think they have provisions in place to get us from here through the end of the year. I think if that stays the course, once again, 2025 is probably the bigger risk for the term premium to widen, no matter who wins. Because that's the whole point, Lisa, is that this fiscal sustainability issue is a bipartisan issue, and we've bought ourselves time. I think the government, the administrators have done a good job of finding ways to fund the government for now, but that risk increases as we go through the end of the year.
Steve Eisman's going to be joining us shortly, and he came on earlier and said there are all these the deficit people who've been worrying about it for a long time. You've replied to it saying, actually, it does matter this time around. But does it matter if the U.S. is just as bad, if not better, than, say, what's going on in Europe, what's going on around the world? Essentially, does it matter that the U.S. is not disciplined if the rest of the world has even less?
Yeah. In other words, you got to be not the slowest hiker for the bear to catch you.
Correct.
No, I think that's, and look, we still have the reserve currency, and I'm not one of these guys who says we're losing the reserve currency and all that. No. I mean, we are in a very privileged position. Okay, I think we've abused that a little bit, and I'm not in the camp that we're going down the tubes. We can't fund the government, but we can get spikes. We can get temporary spikes like last fall, where the multiple went from 21 times to 17 times on the equity market. That's all we're trying to do. We're not here to call the end of the world. I mean, that's silly. Okay, we're just saying that this is a risk that's not currently priced. Term premium is 0 today. And I think that's probably inappropriate given the path that we're on right now, given both candidates, right, no matter who wins.
Mike Wilson of Morgan Stanley, thank you so much for spending time with us this morning. Here's the latest. Treasury is holding steady as traders look ahead to consumer confidence, as well as remarks from Fed Governor Lisa Cook. Greg Peters of PGIM writing this. This remains a reasonably decent backdrop for risk, taken from an overall top-line perspective, yet the valuations are seemingly priced for much of this positivity and perhaps then some. Greg joins us now. This is fascinating to me, Greg, because you're talking about how you get the risk on, but the upside risk from here seems somewhat limited. So what do you do?
Yeah, so I think you have to tread quite carefully, honestly. So, if you strip away valuations, which is impossible to do, of course, we'd be much more bullish. But if you look at spread sectors, for example, you're at very much at the tight end of the historical range, both on the high yield side and investment side. I think investors continue to overpay for levered credit risk. So we see more value in the unlevered or the top of the capital structure. So I think what it means in short, Lisa, is that you have to pull back, make sure you're getting paid for the risk that is on the horizon and always lurks.
So in other words, if I'm hearing you correctly, Greg, right now the concern is that there could be some kind of growth scare akin to what Mike Wilson was talking about with respect to the idea that the credit component could widen out, but not necessarily on the high end of things where it's more duration sensitive. Is that what you're saying? That essentially yields are going to go down. It just matters how quickly and in the face of how much weakness.
Yeah, I think that's right, Lisa. And it's not so much about preparing for a growth scare. Like, that's not a base case over the short term, but you just never know. And these unforeseen circumstances do arise, and you as an investor have to make sure that you're appropriately paid. And we are priced very much for perfection here.
You have seen some of that turn in the high yield market, Greg, where the worst among them has started to finally underperform. That spreads are finally starting to spread out. But in this more leveraged part of the market, the one that you're worried about, why are you worried? How bad does it get in an environment where we maybe get just 1 or 2 Fed cuts this year?
Yeah, so I mean, that point is an excellent one. So what we're excited about in the lever part of the credit markets, like high yield, for example, is that you're seeing this dispersion. And so the markets are differentiating. So that's great news for active managers like us. But in kind of a beta standpoint, it's less exciting. But you don't necessarily need to have a recession or a real downturn to see these levered credits start to bite. And the reason is just the persistence of higher rates starts to eat into these already levered capital structures, and it takes time. And that's why you're seeing higher default and distressed activities for quite some time.
So I guess is 50 basis points of cuts enough to solve that? Or is it cuts in real size to prevent some of the distress?
I don't think it's enough, but it's important to dissect why they're cutting. So if there's a cut because growth is rolling over, that typically means that the top line is also rolling over. And so is that really enough? And my guess is no. If they're cutting because growth is really quite strong, but it's just disinflation in the system allows for some scope, then that's a better narrative. So I think the markets continue to conflate those two narratives. Is it labor market weakening? Is it disinflation? I think both is somewhat heroic.
In the meantime, if you wait for about 2 seconds, you'll get a new narrative. So just hold on 1 minute, and then we'll have a different thing dominating market activity, which really raises the issue that we've been talking about a lot. Lori Cavacino, we keep quoting her, staring into the sun in terms of this election season, given the fact that there's a whole deal of uncertainty. You talk about how most people are just sitting on the sidelines, at least when it comes to bold bets ahead of what we're going to expect in November, but frankly, around the world. So how do you know when you can kind of have conviction given some of the policy uncertainty, or do we kind of already know the outcomes regardless of who gets into office?
I don't think we do know the exact outcomes. If you think about, what's happening in France currently, we saw it in Mexico. It's very much a shot across the bow for, a very big election. But here in the U.S., it's been a very good year thus far. So I just don't see the appetite to take a lot of risks going into the U.S. election. But once we get to the other side, I think the policy differences are quite different and matter a lot. And, I see as a bond investor, I see more concerns around higher bond yields due to inflationary type of policies. And those are the areas that I'm most focused on.
But Greg, isn't that going to be the case for either candidate if they become president?
Not exactly. So I think we're all of the mind that fiscal is very much an issue that's embraced on both sides of the aisle, but the contours of that fiscal are very different. So tax cuts have a very different multiplier effect, let's say, than spending on infrastructure. You look at some of the trade policies, highly inflationary. I just think the details matter here. So just to say, fiscal is going to rage regardless of who's in office and who has control, I think misses the contours of how that fiscal is achieved.
We also need to know the makeup of Congress to really understand what these policies could look like. Do you have a base case of what potentially you're planning for after November 5th?
No, I mean, at the end of the day, I'm a bond investor, right? Not a political analyst. We do provide scenarios because we have to think about it. But I will say, if you just pull it back, zoom out for a moment, everywhere I look, I see more inflationary pressures, not less. You think about it from, a defense spending standpoint. You think about it from just the trade war standpoint. You think about it from, spending on energy, both current needs and then for the future, all inflationary. So the one thing that seems common wherever I look is that there's more pressure for inflation than disinflation.
Just quickly here, do you like French bonds?
Too early, but it definitely looks like there's a path for success here. That's a great example, Lisa, because kind of in the meat of the distribution looks quite attractive. But the extremes are the things that the markets are worried about. And the setup of the French election just makes it difficult with investors trying to kind of game theory that out.
Greg Peters of PGIM Fixed Income, thank you so much for being with us. Really appreciate it. A tech rout pushes markets to take a breather for a hot second. NVIDIA shedding close to $430 billion in value, the biggest three-day loss for any company in history. Even with that slump, and this is the key, the chip giant is up close to 140% this year. Investors still flocking to the company given the sky-high demand for its chips, which are powering a broader AI push. Steve Eisman of Neuberger Berman remains bullish on the AI play, saying the AI frenzy and a correlating boost in infrastructure is powering the U.S. economy. Eisman also expecting Apple to benefit from AI with a major upgrade cycle, and he also has a couple of reviews for the latest Marvel movies. Steve, I'm so pleased to say, joins us now. Steve, who coined "Oi the deficit." I literally quote you every single day on that. We're not going to talk about that just yet. I don't know if that's good or bad. I'm not sure either. A lot of people push back, but I think it perfectly encapsulates what a lot of people have been thinking. And it goes to this broader angst in markets that you kind of push back on. I'm going to start with the question we've been asking all morning. Is the huge swing in NVIDIA shares a sign of market fragility or actually market strength, as Danny pointed out, given the fact that we're not seeing some broader retrenchment?
I mean, if you look at the chart on NVIDIA, you can barely see the correction. So, I mean, on a percentage basis, it's down something like 10%, but you have to peer really, really carefully at the chart to see that move. So I don't think it means anything. There
is this issue, though. How do you even understand the valuations at a certain point? How do you even understand how much future profits are you actually factoring in? I understand the idea of being bullish on AI, but how do you understand when it's so fully valued that you're jumping on a train that's so overpriced?
I absolutely never do. I just don't know. And I'll take the converse to it, which is, one of the things I learned running a hedge fund is that shorting a stock solely because of valuation is a death wish. I made that up too, by the way.
That's great. Trademark.
But what I mean by that is, you go short a stock because you think the valuation is insane, but your entire thesis is just it's very expensive. The people who own that stock know it's expensive, but they're buying into a story. And as long as the story is intact, like NVIDIA is obviously intact, the story is going to continue. So you have to have, when you short something, not just that it's expensive, it's that the story is going to break. And as far as I can tell, the NVIDIA story is going to last for years. So, I don't think all that much about the valuation of NVIDIA.
So maybe you don't want to short it because it's a narrative and it's an enduring and a powerful narrative.
I own it.
So you own it. Okay, question for you then. You look at 10% dip, 12 whatever it was on the chart. Do you buy more?
Well, we own a lot, so there's portfolio construction issues about how much you can have in a portfolio. One of the interesting things about this market, which presents a problem to portfolio managers today, which I don't think has existed before, is that some of these stocks, Nvidia, Apple, Microsoft, represent very large percentages of the S&P. And so, normally, if you would take a position in a stock, you would say like a 5% position would be a big position in the stock. But those stocks have bigger positions in the S&P. So you're sort of, the normal risk parameters that apply to constructing portfolio don't necessarily apply to these stocks.
I think that's such an interesting point. Also because if you're an active manager and you want to outperform, you kind of have to be so overweight these stocks.
Or at least equal weight.
Which again is kind of beyond the normal risk parameters to have so much concentration in these stocks. So even though the story is there and it is powerful, does that do something to your volatility profile, which you maybe don't like, when you can have swings like this in Nvidia over a 3-day basis?
I don't really focus that much on the volatility. I have a colleague at Neuberger who likes to say that one of the benefits of buying and holding is that you only have to make one decision. Whereas if you're a trader, you have to make multiple decisions, and it increases the probability of you making a mistake. So if you like the Nvidia story, you own it, and you keep owning it until something changes. And I don't think it's going to change for a long time, so we'll own it.
If you like Nvidia, do you also like Micron and AMD? I mean, do all of the sort of semiconductor stocks benefit equally?
But you can't own everything, unless you just own the index.
Yeah.
So we like AMD. We don't own every chip stock. One of the things that I think is very interesting is when you're talking about, leave out Microsoft, software versus hardware. So for years, software outperformed hardware. And one of the reasons that software outperformed hardware is that the whole software industry moved to the SaaS model, which everybody went crazy about, et cetera, et cetera. There's an argument to be made that hardware, which has recently outperformed software, is going to continue to outperform software. And this is an outgrowth of AI. And this is not my theory. I'm not smart enough to create this one. But it's a very interesting theory. I think we should talk about it for a little bit. It's a very long-term story. And the thesis is that because of AI, the cost of creating software is going to collapse. And so therefore, some companies, unclear who, in the software industry, which people value very highly because they have these very large moats, those moats are not going to be so high anymore. Now, if this thesis becomes true, then hardware will continue to outperform software, and software will get derated. That's a very long-term story, but I think it's very interesting.
But this hardware is coming from Taiwan. Do you have any sort of concern about the geopolitical?
I'm petrified.
No, seriously.
No, I think, look, God forbid we wake up one morning and China has invaded Taiwan. Our economy gets hurt very, very, very badly. Because where are we going to get our chips? I mean, that's one reason why Taiwan Semiconductor is building plants in the United States, but they haven't been built yet.
Yeah, but we're years
from that.
Years.
No, I agree. Is that
your biggest risk for holding all this Nvidia?
That geopolitical risk is the biggest risk, I think, to the market, and I have no way to predict it.
Well, so to me, this sort of raises a question. Is it going to be geopolitics or a growth scare? We were talking to Mike Wilson earlier, and he was saying a growth scare could torpedo some of these lifeboats in particular, some of the semiconductor providers, just simply because there won't be as much investment. Are you saying that's even less of a risk?
I don't see a growth scare at this point. I really don't. I mean, you guys were talking before about the Fed. My view on the Fed is it's not relevant. And the reason why I say that is, the Fed was relevant when it was raising rates 500 basis points. That's relevant. That's repricing of money. The people who are the most dovish, what are they talking about? One rate cut this year, maybe one or two rate cuts next year. In the scheme of things, de minimis. It's not really. I mean, it'll be important on Fed Day. You know, like I think I said here before. You know, on Fed Day, they treat Powell like, you know, Moses coming down with the tablets. Let's check to make sure the 10 Commandments have the same words in them that they had last time, because that'll change morality forever.
Good.
But other than that, it's not that relevant.
Okay. So just putting this all together before we shift to politics in just a bit. I am curious about the idea of crowding risk. If there is potentially a catalyst, some invasion, or even just increasing tensions in around Taiwan, how difficult could that be, given how crowded some of these names are, in order to exit? What could potentially happen? I mean, is that something to even prepare for, or is it just something that's so cataclysmic it's not even worth it?
The way I think about that is, look, like I said, God forbid China invades Taiwan. We'll have a lot more problems than what's in my portfolio. You know, so we'll all lose money. You know what? That'll be the least of our issues.
Okay. Well said, Steve. Okay, with all of this, I can't help but wonder why I should do anything other than just hold the S&P 500. Why I should do anything other than just hold a passive portfolio, because that gives me exposure to all the big
That
caps.
is fine for a lot of people.
Sure.
I have no arguments about that. I do think that we are in an era of stories, more so than we've been in a very long time. And you can construct a portfolio which emphasizes some of those stories more than just the S&P does, and you could outperform. That's how I look at it.
You have some pretty bold stances on it, and I want to know whether you're actually betting on that sort of 200% confidence that you have that Donald Trump is going to be the next president. I mean, how do you translate conviction in politics into actual wagers in the market?
This is going to sound a little strange. I actually think it doesn't matter who's president for the market overall. I really don't. I just think some of these themes of AI and infrastructure are just so powerful that it doesn't matter. Now, on the margins, there'll be, you know, certain sectors. So if Donald Trump gets elected, I'm sure natural gas stocks will do better. Some solar stocks will probably do worse. So there'll be subsectors where things will be better and things will be worse, but for the overall market, I don't think it matters. I just don't think it matters at all.
Well, what do you make of these 16 Nobel laureate economists coming out today saying that Trump's going to be an inflation bomb on the economy, and he's worse in terms of inflation than Biden?
I think it's ridiculous. I just think it's ridiculous. I mean, based on what? Because there'll be more tariffs.
Tariffs, tax cuts.
Does that mean it'll be slightly inflationary? Maybe, but you know, one thing I've always learned about things as broad as like things like inflation is things that cause inflation or cause inflation to get better are so broad, and there's so many factors that, you know, the fact that Donald Trump's going to be president is maybe marginal.
Since last time you were here, when you shrugged off the people concerned about the deficit, calling them the deficit people, the nonpartisan Congressional Budget Office ramped up its estimates for the U.S. budget deficit by 27%. Mm-hmm. There is growing concern about the U.S. fiscal trajectory. Does any of this concern you at all since the last time we spoke to you?
So this is why it really doesn't concern me long term. At the end of the day, the U.S. dollar is the reserve currency of the world. And one of the major reasons why it is the reserve currency of the world is that we have the most liquid and best government bond market in the world. So if you're a major institution, basically anywhere on planet Earth, and you need to park money, you buy U.S. Treasuries. That's what you do. There's no alternative. You're not going to buy Italian bonds. You're not going to buy Chinese bonds. You're not going to buy, you know, Mallorca bonds. You have to buy something that is big, liquid, etc. And as long as that's the case, the U.S. dollar is going to remain the reserve currency of the world. And until somebody can show me why there's an alternative to the U.S. government bond market, will remain the reserve currency, and the deficit is just not going to be that important.
There is this issue, though, of policy consistency and this idea of exactly how the U.S. can be consistent in how it approaches markets, how it approaches the world, and working together with allies and some of these issues that do factor into the U.S. being the most liquid market in the world. And on the margin, some people say it's not going to happen all at once, but you could see that erosion. And people aren't worried about a wholesale blowout in yields, but just sort of more volatility on the heels of certain proposals and things of that nature. Are you basically saying it doesn't matter long term because we'll move past that and it'll just be these main themes? Or are you just saying that honestly
people
you don't
need
see that
things
happening?
to talk about? And they need something to kvetch about. Okay, so they'll kvetch. And we'll go, the deficit. That's how they kvetch, you know. But at the end of the day, the dollar's a dollar in the U.S. government bond market. It's the U.S. government bond market. And as long as that remains the case, we can have deficits. Now, do I think at some point it'll be important? Maybe, but people are pontificating. Do you see rates going up? I don't see them going up. They're going down. So until then, next story, basically.
Okay, well, I'm going to do an adjacent story.
Fine.
I apologize in advance.
Don't apologize.
But one of the concerns about it is that, sure, central banks hold bonds, but the switch has happened. We're now it's foreigner individuals who are the biggest holder of bonds. They've supplanted foreign central banks that are the biggest holder of bonds.
Right.
You're also in this environment where, because of more regulation, banks are holding less on their balance sheets. So all of a sudden, there's more potential for upset in this bond market. Not necessarily that the deficit will necessarily cause it, but weaker hands are holding on to bonds now.
I don't think they're so weak. Is there any indication that they're weak? 10 years gone from 4.5 to 4.2. I don't lose sleep at night about this one. I just don't.
All right, so then I guess that the bigger picture is how
I sleep very well, by the way.
I can tell, and you watch a lot of movies,
I do.
And you have a great life, and you've been along some of the bonds that have won, some of the stocks, that have won the biggest. I am wondering, though, exactly how you diversify then. Do you just not diversify? Do you have enough conviction to say, these are the things that are going to win, or do you need some sort of ballast that could be the bond market, that could be cash?
I mean, first of all, it's nice to be able to buy 3 months U.S. Treasuries and get more than 5%. So if you need to park some cash, that's fine. Owning some corporate bonds is fine too. But, generally what we do is equities, and that's what we've always done.
So you do equities and you do movies?
And just U.S.
Yeah, and just U.S. You also do movies. Do you have any new recommendations, since you do have this list of 100 in the Steve Eisman catalog?
I don't have a new movie recommendation. There was a new show on Hulu called The Veil with Elizabeth Moss, which was pretty good.
She's excellent.
My favorite is that he's into Bridgerton. He's an equal opportunity reviewer, although not so into Marvel, right? You're pretty passionate.
Well, I'm very passionate about it. I'm just very upset about what's happened.
All right. Well, we'll get into that another time. Steve Eisman of Neuberger Berman, thank you so much for being with us. Always a pleasure.
Thank you.
Always insightful as he sort of touts the AI narrative.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.